One of the big talking points of the markets, and indeed it has been for the last several weeks or so, has been what's happening with the price of gold. We've seen it soar past the past record high back in September 2011 of $1,921 the ounce. It's soared past that. It went past the 2,000 level, and people were happy holding gold. Last couple of days, we've seen the gold chart pull back. Let's take a look at the chart before we talk to our guest to talk about what's happening with the price of gold. I've put on here a Fibonacci from the swing low that we had back at the middle of June, when we were down at this line at 1,796. The swing high that we've had, the record high at 2,074, which we had, just a few days ago. Since then, we've seen this pullback. Now, intraday today, we've seen a spike low all the way down to 1,861. For me, that's an interesting point of support. That's a 76.4% retracement of this move, and that is a very big Fibonacci support area. You can see yesterday we got support at 61.8%, but it did go lower than that. But I think we've got this interesting hammer candle shape now, giving an indication to me that we have a possible buying opportunity from these lows. Let's bring in our guest now to talk about some of the fundamentals around this. We're talking now to a regular guest here on IGTV, John Meyer, mining analyst and one of the founders of SP Angel. John, thanks indeed for coming on and talking about this price of gold. I know you look at things from the fundamental aspects. I was talking a little bit about some of the trading that's been going on. One of the big questions has been, not just from IG clients, but around the markets, are we in for further declines for the price of gold? Or, as I've just suggested, potentially, have we seen this most recent bottom again?
Jeremy, yes, I am definitely a fundamentalist when it comes to these things, but I also agree that looking at the charts helps to crystallize the fundamental view. And I think any trader or investor should actually always look at the charts to see whether something has been overbought. Yes, I do think gold has been overbought in the short term, but I also see the fundamentals as supporting a higher gold price than where we are now potentially. Yes, I do see also the gold price coming back short term to about 1875. I think your charts probably support that kind of view, and there are so many people who trade and invest on the charts that I think that becomes a self-fulfilling prophecy. But fundamentally, there's still a lot of money coming into gold. The world has been through and is still going through a very uncertain environment. US interest rates are extremely low. US bond yields, are moving around. There's a little bit more confidence in the dollar. There's less certainty that the Americans are going to vote through a huge Trump-esque stimulus package. There is certainly less certainty that Trump is going to win the next election, which has its own ramifications, I think. So we're in an environment where there's still a great deal of uncertainty, and I think that helps to support gold. And I just don't see gold going back to $1,200 an ounce, and I think this is an important thing for the market to understand.
Yeah, just wanted to ask you as well, how do you play this gold market? Because as many will say, holding gold, it delivers no benefit long term. It's got no dividends. It's got no benefit necessarily in as much as it's only a piece of yellow metal. Okay, you can get benefit on the upside, but how do you best play this rise in the precious metal space?
Well, gold has really demonstrated in the last few months its value as a store of value and as an alternative to currencies and many other asset classes. Certainly better than holding a lot of bonds right now in a low yield environment. And of course you've got the Russians and the Chinese and many other central banks all supporting it. You've got huge numbers of Robinhood investors in the States buying into gold for the first time. You've got ETF gold holdings continuing to increase. In fact, the numbers today were slightly off, and that's the first time we've seen those numbers tick back for a while. And I'm sure that's the more speculative element of things. But for us, the real way to play this is in the gold mining companies themselves, the gold equities. And we would advise a lot of investors look for start off with some of the bigger stocks. You've got Newmont Mining and Barrick in North America. Newcrest is the big one in Australia. And in the UK, companies like Centamin, Charac Gold, Sol Gold, There's a whole raft of smaller companies. In fact, the traditional South Africans, Anglo Gold and Sibanye Stillwater. And for me, all these stocks look good value right now because they're still valued at gold price levels that are much lower than where we are now. The market has stared at the rise in the gold price in disbelief. It's correctly waited for the price to come off, waited for some of that over exuberance to come out of the market, but it's not yet reflecting the shall we say, longer term higher price for gold. And I think, yes, I think there's quite a lot more room for these stocks to rise, and I think investors will be well rewarded, because almost every gold mining company in the world is producing well over $1,000 an ounce of free cash flow. It's huge money. None of it was expected. They've also got benefits from lower oil prices, and let's face it, fuel is normally 30 to 40% of the operating cost of any of these companies. Then you've got weaker local currencies. So many of these companies are operating in emerging market countries where the currencies have pulled back quite rightly because of recession, the recessionary impact of the coronavirus and the recession in the first half or the second quarter anyway. So yeah, there's a lot more benefit to come through from holding these equities, and so many investors have just played the gold market by buying into the ETFs. And yes, those instruments are liquid and they've had great upside. But if you want to buy further upside now into gold, buy the gold equities.
When we've spoken before, John, we've spoken about things like copper, for example. I know that you were saying that for some of the copper miners, COVID has caused a real problem, especially for Latin American countries, which are big copper producers, and that the supply of copper has come down because mines have had to be closed because of COVID-19. Is the same thing happening in the gold market? I mean, you've got this big demand coming through for those that want to hold bullion, those that are trying to get exposure to this sort of part of the market. Lots of demand. Has supply dried up in any way, shape, or form because of the effects that have hit the copper market so much?
Well, we haven't seen much news on this, but you are correct in that the virus will have impacted gold production, particularly in Peru and Mexico and Brazil, where the virus seems to have hit families very hard. And when the family unit is hit hard, the breadwinners are often required to be at home to manage things rather than working, digging out the gold. So there is that sort of, shall we say, slightly unseen impact. We know in South Africa, the gold miners, who all are very deep level gold miners, suffered a very significant impact in the second quarter, some in the first quarter, mainly in the second quarter, where they lost the full 35 days, but where it's also been very difficult to go back in underground to start working again. Now, we know for the South African platinum miners that they have more than made up for shall we say, working restrictions by much higher prices of platinum and palladium. So if you look at Sibanye Stillwater, which has a lot of deep level mines in gold and platinum, palladium, that and as well as open cast operations with its North American operations. So we know that they actually have, that there should be a net benefit, or we believe there should be a net benefit for these guys, and that's why it would be a key recommendation from us. But look, the gold miners will do much better as a result of higher prices, despite the pullback in production in the first half.
What else is happening in your space, in your world, in mining at least, that's going on, that's causing you some interest at the moment?
Well, we're a bit concerned about the flooding on the Yangtze River. 2 million people affected by that, hundreds of thousands of people displaced. Different estimates on the cost of it to the Chinese economy. I've seen ranges from $20 to $30 billion estimated. Huge amounts of farmland and rice crops just completely destroyed. The Chinese are keeping fairly quiet about it because it's actually affecting Chinese inflation. I think food inflation is up by 12–15% at the moment, depends on which figures you're looking at. The Chinese authorities are buying vast quantities of rice and soybeans from American farmers. They don't seem to want to make much noise or announcements on that. it's very helpful to them from a trade war perspective, but I don't think they want to give Donald Trump the pleasure of claiming credit for any of that. So that may be why they're keeping quiet on it. But they are having to, they've released stocks from their own strategic stockpiles to feed to make up the losses on that farmland and to feed the Chinese people. And there's a lot more buying I think they'll have to do, particularly to ensure that they've got seed for next year's rice and soybean crops. So they have a major disruption from that, probably larger disruption than was seen with the coronavirus initially. It's certainly affected smelters and copper production, lead and zinc production, where the logistics have been disrupted along the Yangtze. The Yangtze River runs for about 6,500 kilometers through China, so it's absolutely huge. It runs through most of the Chinese provinces as well, certainly where there's a lot of industrial and economic activity. So we see the impact of the flooding on the Yangtze, and it's not yet over, as causing yet another delay to the Chinese recovery. And I know they're pushing it very hard. But as they come out of the flooding, they're going to be building an awful lot in the way of flood defenses and restarting the economies in those local areas. And I actually see that as amazingly good for metals consumption. They'll be buying a lot of vanadium, iron ore. Well, we see they're buying a huge amount of iron ore at the moment, with iron ore prices at very high levels, close to $110 a ton. Huge amounts of steel consumption going on in China, and we see that as being an important part of the restart of economic growth, a big driver for for metals demand, and yes, it may even create a second super cycle.
Yeah, I tried to pick up, if I can, on one metal in particular. Again, we've spoken about before, as I said earlier, was copper. We look at the copper price chart here. Interestingly enough, talking about using the charts and talking about using some of the technical analysis. And one of the things I was saying to clients this morning is this push lower for momentum on copper. We've got this drop that we've seen in the last few days, the price of copper at the moment at what, 63.80 it is. Where do you see copper going? Is it like gold? Are you expecting a slightly lower print before you get in to get a better price to move higher? You talk about the slight stalling to the economic recovery in China. Is this going to have a lasting effect on the downside for the copper price?
It's really difficult to tell. I'm not sure there's a lot of downside in the copper price, but the Chinese were actively buying up a lot of copper around the world. We heard from traders that they were worried that the Chinese were spoofing the market, that they were buying so much copper. Then we saw a lot of copper come out of LME warehouses, and suddenly there was a big dump of copper into Shanghai. We think that was really just copper being moved, being shipped into China. We think that the Chinese will be buying that copper for industry and for industrial consumption. But I do feel that the flooding on the Yangtze may just delay that a little bit. So yes, we do see higher prices for copper. We certainly see the electric vehicle revolution as driving copper and nickel, and we saw quite a big move in nickel sulfate prices. The important thing there is that nickel sulfate is being used for battery production, for new electric vehicle batteries. We also see that certain battery manufacturers are moving towards NMC batteries, which use more nickel and less cobalt, and they got longer range, greater power density, and faster charging times. So we're told. We thought this had been stalled because there were problems with getting those batteries right, but it looks like that's back on track now. So it's good news for people who are going to buy electric vehicles, shall we say, next year. I'm not sure these will be in vehicles this year, but certainly Ford and certain other manufacturers are going to use these NMC batteries. I think the new electric Ford F-150 truck is going to have those, from what I see. So yes, there's better news on the environment there. And yes, that'll be a big driver for copper demand, nickel demand, and one or two other metals. And the Chinese are putting a lot of new infrastructure money into electric vehicle charging points. So don't forget that. We saw news on that in Shanghai and certain other areas. It's difficult to collate all the news on the Chinese infrastructure projects because they're not making big grandiose announcements. It's all happening at a local level, but there's certainly a lot of that going on.
Okay, John, interesting. Thanks indeed for joining us. Our regular update there from the mining sector. John Meyer from SP Angel talking about copper, but more importantly about the direction of gold, possible lower print in terms of pricing before we take another lift off. That's John Meyer from SP Angel. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.